Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
Target reported fiscal second quarter earnings before the market opened on Wednesday, and the results were really a mixed bag, but the stock is up about 4%. So I want to cover exactly what's going on, what the big trends are, because there's some changes in retail over the last year or so that we should keep in mind, especially when it comes to comparing it to the results at Target. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I'm going to go straight to the earnings release from Target. I'm going to start with the statement of operations, or the income statement. The one thing to keep in mind is that same-store sales were down 5.4%. So that's why you see, we start on the top line here, sales overall were down 4.9%. So there's a few stores added. That's why overall sales not quite down as much as same-store sales. But if we go down to cost of sales, or cost of goods sold, that was down 11.6%. As a result, operating income was actually up sharply, nearly 300%. So what's going on here is that you might remember a year ago, Target basically had the wrong inventory. As we came out of the pandemic, they had prepared for people buying things like home furniture, stuff that they were buying when they were staying at home more during the pandemic. But people were starting to go back to work. So they had to discount those products and sell them off, sometimes at a loss. Clear through that inventory. That resulted in a couple of pretty weak quarters. And what we're seeing right now is Target coming out of that. So despite the fact that revenue was down in the quarter, we actually see income going up. But that's the reason behind that. From an earnings perspective, net income up 357% to $835 million, or $1.80 per share. You can see some of the changes in those inventory movements that I talked about earlier. $12.7 billion worth of inventory. A year ago, that was $15.3 billion worth of inventory. So a big change in inventory, and that's a big reason in the increase in operating income. If we go down to the statement of cash flows, this is for the 6 months ended July 29th, but you can see that there's $3.4 billion worth of cash from operations and then $2.8 billion worth of capital expenditures. So overall, cash and equivalents at the end of the period after paying a dividend, reducing long-term debt a little bit, $1.6 billion versus $1.1 billion a year ago. Some of the trends in the operating results were really interesting. Here you get a little bit of the gross margin and SG&A expense rate. So like I said earlier, gross margin was up pretty sharply, now 27%. SG&A, which is operating costs, were up. That's partly because revenue was down. So nothing to be too alarmed by, but just keep that number in mind because we do want to see some operating leverage when Target starts to grow again. Comparable same-store sales down 5.4%. And the driver there was fewer transactions. If we look at the sales by channel, the shopping actually in store was only down 4.3%. That's this number right here. And then digital sales, which is drive up, pick up, and shipped, were down 10.5%. So what's going on is that people are actually going into the store more than they were previously. Remember that those digital channels grew tremendously during the pandemic. So there may be some shifting back to the way people used to shop, but there is absolutely overall a shift to this new digital type of shopping and on the Target app. So I think that's generally a positive trend, but it's not going to be growing in a straight line. So that's why we see some of the ebb and flow there in the numbers. From a stock standpoint, why were shares up today? Well, the big reason is there was this big drop in May. You might remember during Pride Month, Target had some controversy there. I don't need to go over that here, but the fear from Wall Street's perspective is that there was going to be a big backlash and a drop in sales, a lot like we've seen at Budweiser. That did not appear to happen, at least in a big way, maybe a couple of percentage points of sales, but those customers did start to come back. Now, management does expect revenue to decline this fiscal year, so the trends are not moving in the right direction. But like I said before, not as bad as was previously anticipated, and as I'm recording, the stock is up about 4%, was trading even higher than that earlier today. So that's the reason for the price action over the last couple of months. The general trends to think about is that consumers are just generally spending less on retail than they were a year ago. So we've seen falling results from Target. We've seen that at Home Depot. Consumer trends are shifting. And one of the concerns that has been brought up is that now with student loan repayments starting in the next month or two, we could see even more pressure on consumers. Add in the fact that interest rates are up, auto loan rates are up, mortgage rates are up. Everything is getting more expensive. Does that pinch consumers at a place like Target? And it appears that management is at least preparing for that. So that's one of the reasons to be a little bit cautious. But I think operationally, the positive is that Target is returning to profitability and better margins that we saw a year ago after some of those inventory challenges. So that's why I said this is a mixed bag from a results standpoint. You don't want to see revenue falling at a retailer, but it's understandable why that's happening from a macro perspective. There was some Target self-inflicted wounds there. But I think going forward, this is going to be a company that's going to just grow steadily and surely as retail sales grow. And we did see strong margins at Target. The company, the company's not having to discount just to drum up the sales that it is getting. It's actually squeezing a little bit more margins than it did a year ago. So still solidly profitable. As I'm recording, the price to earnings multiple is 22. Next 12-month price to earnings multiple is 16. So not a cheap stock by any means, but a fairly reasonable valuation. Not necessarily one that I'm buying right now, but if the stock does fall, I do think Target is one of the better retailers out there and would like to pick it up at a discount. But right now, a mixed bag result is not really a buying sign for me, despite the fact that I do like the long-term trends for Target. But what did you think about the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.